good morning, everybody. We'll take a little bit of time for everyone to just catch up and come on. So we just kind of do some introductions why that's happening. Welcome to STS's webinar for 2023. Is it still? We can still say Happy New Year to everyone who's on, can't we? I think it's we can still just about say that. My name is Andrew Markham. I head up the consultancy side of SDS, and I'm joined with some of my colleagues and a guest that is a very experienced guest. Yes, I know, Duncan, very experienced person in the sector, and pleased to have him on board today. And John, let's go through us and introduce ourselves. Who's going to be our speakers? John.
Hello, I'm John Stevens. Hopefully met most of you, maybe our paths have crossed. Yeah, and I'm very passionate about delivering more affordable housing, and I've done that for 30 years. So here I am. Yeah.
Excellent. Duncan.
Thanks, Andrew. Morning, everyone. My name is Duncan Smith. I'm currently unemployed. Jeepers. So what do I have in terms of knowledge? But if anybody needs an experienced development director, I'm available for business. And I'm going to talk to you a little bit this morning about practical things to aid in the delivery of affordable housing during an alleged economic downturn.
Exactly. Okay. And Amanda.
Morning, everybody. So for those of you who have not met me before, I'm Amanda Walton. I'm working with SDS now as a consultant, but my background is in finance. So I've been working as a finance manager previously for a few housing associations. So that's me, and I'm going to be looking at the finance viewpoint this morning.
Excellent. Okay, thank you, guys. Right. So yes, the question that we have been given, actually. So we obviously get feedback from our clients who attend these webinars, and we always ask for topics. And the topic or question that was posed to us by a client was, how do we maintain output in a downturn? So I thought, okay, right, let's go out to the people we know and let's pose that question, and let's have some presentations of their thoughts of what's happening. Obviously, 2023 is looking to be a very challenging year. But not necessarily kind of all doom and gloom, and I hope that we can get some kind of tidbits of information, insight from our speakers today. And you know, as always, ask questions. So there should be time, you know, after each presentation, if there's a burning question that kind of resonates, you want to ask, please do so in the normal way. You can do it on the chat. I've got our marketing manager, Cassie, looking at that, so helping us kind of look at the questions so I don't miss it. And also, this will be quite interesting, we've got some polls. We're going to try and kind of interact with you guys, answer these polls for us, and we can kind of discuss that at the end of the poll and the results. So it should be quite interesting. Right, so we are going to start with John Stevens, and the question that we asked him was, how do we maintain output in a downturn? As John has just already alluded, that his experience in the sector is kind of second to none. Been working in this industry for over 30 years, obviously just out of school, and straight from school on that thread. John is a trained architect, has worked in development, as I say, for over 30 years with housing associations, local authorities and community groups, and developers across the wider range of schemes and tenures. Mixing technical knowledge with financial evaluation, John has consistently delivered innovative solutions in the affordable housing sector, including energy efficient homes and modern methods of construction. So projects he's been involved with multiple large schemes, value engineering, homes, and flexible tenures. So over to John. Now, I'm John running the kind of slide, so give me a shout when you are ready to move on. And
just click away and I'll try and keep up. Right, okay.
There we go.
So the subject was maintaining output in a downturn. Just keep clicking away, Andrew.
Okay.
So the Office for Budget Responsibility says we're in recession, and we'll probably be in here for the whole of this year. Next, keep clicking away, Andrew. The Office for National Statistics said that the economy shrank by 0.3% in the 3 months to November. There's a lovely slide from the BBC. Let's go on to the next slide. We've got a lot of content for a short amount of time. So the factors facing us are compounding into obstacles. So we've got CPI inflation rapidly moving from 2 to 10%. We've got increasing energy and food costs on households. Keep going, Andrew. The rent ceiling in our sector has been placed on social rent at 7% for existing tenants. And connected with that, the local housing allowance has been frozen since March 2020, the start of COVID. We've also had, in addition to that, the construction sector having inflation, significant inflation rises in material costs. And we've also had a challenge with labour in the construction market, especially skilled labour. We've had challenges on mortgage interest rates and uncertainty involved with associated for sale housing. So we've got these obstacles occurring. But actually, when you start looking back in history, how did people deal with crises in the past, if indeed this is a crisis? Well, Mr. John F. Kennedy said the Chinese word for crisis is composed of two characters, one representing danger and the other representing opportunity. And then I looked for a quote on opportunity, and Thomas Edison said, opportunity is missed by most people because it's dressed in overalls and looks like work. Yeah. So if we feel we're challenged and in a crisis, maybe we need to look for opportunities, and maybe we actually need to put some work in. So the next slide, if we move on, is basically reflections I've received from the sector. And when people perceive there is a downturn, what do we, is there really a downturn? Maybe there's a downturn in the general house building, the commercial house building market, but oftentimes that presents great opportunities for the RP sector in terms of building and continuity of business. So I've been talking to various affordable housing providers recently and gained from them reflections of what they're seeing in the sector. So if we go through these, Andrew, they're getting significant increase in developers coming to them, wanting to contract with them. There are opportunities for additionality on 106 agreements and rephasing those sites as well. So there's additionality. Some of the commercial house builders are only actively contracting with RPs and HAs and actually slowing or stalling their own commercial sites. So they're really focusing on the RP business. Carry on, Andrew. Yeah, we've heard some for-profit RPs are taking a break from purchasing new sites, actually pursuing new commercial sites. And also that the MMC providers have switched their focus to the public sector. So away from delivering perhaps with commercial partners, they're actually looking at local authorities in terms of MMC volume for the near to medium future. Keep going, Andrew. There's more content from the sector. We've obviously got pressures on all our budgets about alternative agendas. So whether that's decarbonisation, stock condition, etc. We have seen and heard some people we work with, they're facing challenges because delivery partners, construction companies have collapsed. But what I would emphasize is there is a demand, Duncan, for skilled development staff and consultants to meet these challenges. So with this kind of refocusing on the RPHA sector by the commercial guys, have the housing associations got the right staff with the right skill set to deliver and evaluate these opportunities? Not only the staff to do the viabilities, but also the consultants who understand their processes and can swiftly get into contract. Yeah, okay, keep going, Andrew. What have we got? Oh, we've heard about sales success or continuing sales success by getting closer to your customer. So be a bit more alert. Actually, is there a mortgage accessibility issue? Is it something we can help with? Is there an element of employment insurance? I've seen that in the past engaged with. I've also seen equity guarantee engaged with. So if you buy with us, then maybe we will guarantee no negative equity over a period of time. And ultimately, have we got mortgage rescue or reverse staircasing, tenure turning in place to give confidence to people that we are a responsible partner to engage with? So we're getting all these reflected back to SDS, and significantly we re-granting a new term, re-granting of opportunities with Homes England. Yeah, it didn't work under that. It no longer works under the current costs, under the current challenges. If you want this scheme, and yes, we love to provide more affordable homes. If you want this scheme, we're going to have to re-grant it with Homes England. So lots of people stalling their schemes and actually saying we've got to go back for more grant, because there is a continued lack of supply of in our sector of affordable homes. So when the commercial areas have a downturn, which is probably what's going on, we actually pick up opportunities, and that's what we're seeing reflected in the sector. If you'd like to press on. So what can we do about the program? Well, basically, you could review your program into must, should, could projects and look at the tenures and look at the timings. Keep going, Andrew. There's a lot to cover.
Sorry. Yeah.
If you are facing, or if you are given intriguing new opportunities, have you got the financial capacity for these changes, for these replacements? So that's where Amanda comes in terms of looking at the business plan and actually saying, okay, if we stall something, or we phase it a bit slower, or we change our delivery profile on something, have we got financial opportunity available, financial capacity available for these new opportunities? That's really key, because you can see these opportunities coming past your door, but if you can't jump and actually commit to them, they'll pass you by. Delivery means deals, so be prepared to negotiate or re-grant with Homes England, a previous point. Remember keeping your board involved and get their support and reporting to them. Remember the value of effective board support. Okay, so that's on program. Keep going, Andrew. Existing projects, get closer to your contractors and review your contracts, refresh the conversation, perhaps talking about phasing and timing, and as a due diligence, maybe have your own informal risk assessment of that contractor and the contract at the time, and engage the contractor in conversation about, keep going, Andrew, potentially rephasing. Is it necessary? Yeah. Do we need to look at retenuring some of the deal that we've got? Is there any additionality for us here? Can we offer them some confidence? I've seen an arrangement with a developer where if they don't achieve sales, then those units can actually become additionality units. So get closer to the contractor and refresh the conversation. Do we need to re-grant that contract and that project? And in the wider picture, is there potential to change your position and actually become a joint venture partner on this development? I think that's something Duncan's going to be talking about later on. My personal view at the moment is there aren't enough joint ventures going on in the sector, and the local authorities need to wake up to the skill set that they could quickly get on board and deliver increased development if they joint ventured both with RPs but also contractors. Okay, so we're happy with that page. Keep going.
Yep, sorry.
Yeah. Next time I might be in charge of the buttons, you never know.
Yeah. In the background, John, I'm trying to do a couple of things. And it's, you know,
okay.
I'm not good at doing 2 or 3 things at once. So that's why the poll is going to be right interesting. Anyway.
Okay, we've got a lot to cover.
Important.
You know, there's
so
much opportunity out there. Come on. Keep going.
Go on.
Shared ownership and outright sale. What are we going to do about this?
Yes. Oh, there we go.
There we go. Again, it's the same advice. Get closer to your purchasers, listen. What are their concerns? And do your own informal risk assessment. I'm keeping banging on about that one. Do an informal risk assessment of your purchasers. It may include, keep going. Yeah, have they got issues with their mortgage accessibility? Could we support that better? Do we need to look at employment insurance as part of a purchaser package? I've seen that used before. Do we need to cover their concerns about negative equity? What would happen if we actually said, we'll guarantee no negative equity over a period of 6 years on the initial purchase value? Surely within 6 years, with the lack of supply in the market, we're actually going to cover that negative equity. Think about these positions. Mortgage rescue, reverse staircasing, tenure adaptability. Could we save the day? Could we actually be the marvelous people we are in the communities and actually give comfort and assurance to people who are purchasing with us? On a people scale, keep going. Good information and prompt communication is key. So maybe it's worth sitting down with your team and actually saying, look out for these challenges. Good information is key. Keep that communication running back into the teams so we can actually assess what's going out there with projects. Keep going, Andrew. Hold on to those skilled staff who are available to do evaluations for you. They are like gold dust at the moment. Getting hold of proficient, skilled staff is a real challenge. And also those consultants, those solicitors who know your processes and procedures, who are able to work with contractors and get into contract and give confidence to those new contractors and opportunities that are appearing. So treat your staff and consultants well. And just in case, revisit your contractor insolvency processes. I've seen this happen in real life. Day one issues are site security, getting hold of photographs of progress and certification records. Just a bit of an anecdote. I saw a contractor go into supervision and the subcontractors started turning up and removing items that they felt they hadn't been paid for. So site security is a huge issue on day one if you do unfortunately have to go down that path. So good information, effective evaluation, clear communication, prompt action. Yeah, okay, let's keep going. Yeah, review, remodel, and reprogram. Those are my potential guides on that. How am I doing for time? I'm a little bit over.
No, you're okay.
But,
You're a couple of minutes up. That's fine. We're doing really well.
Okay, and this is entirely aside, but it's something I came across that might be of benefit. If you don't take any benefit from everything else that we've covered so far, take this nugget away and check it with your finance people. So here we go, Andrew. How is your long-term interest rate inside ProVal? Yeah, what borrowing rate have you got? Keep going, Andrew. Versus your net present value discount rate. This is getting a bit anarchy and a bit technical. But basically, inside ProVal, what's your borrowing rate against your net present value discount rate? And have you got differences in the net present value discount rate between tenures? So is the NPV rate on social rent different to the NPV rate on shared ownership? So if your key tenure, your bread and butter tenure that you're delivering with your social purpose is social rent, affordable rent, is backed by significant housing need, large waiting lists with the local authorities you work with, I'm asking, what risk is there to your organisation in developing homes? There isn't a risk. So why have you got a margin on your NPV rate compared to your borrowing rate? That's the question. Some organisations won't have a difference, and we see that, and they're more effective. But if you talk to your finance people or look inside ProVal, and your long-term interest rate is different to your net present value discount rate on 10 years, go and ask your finance team, because what is the risk, especially on those key 10 years? We also make allowances for voids and bad debts in our appraisals. So we're already taking on board that issue of voids and bad debts. Keep going, Andrew.
God, I was enjoying what you were saying there, John. I was just
and
turning it over.
And you also might have a grant agreement with Homes England that says a permanent home needs to be managed for a minimum of 60 years. So again, where's the risk on social rent, affordable rent, NPV rate being the same as interest rate? If you do move them to be equal to each other on those key tenures, if there is a low risk tenure and your NPV discount rate matches your long-term interest rate, your project NPV, Andrew, your NPV performance will be the most efficient, obviously subject to other inputs on your appraisal. But this is the nugget of information I'd ask you to take away today and actually speak to your finance people about, because you'll see a significant change. And it might answer your question, why in Proval can my loan be repaid, but I'm still getting a negative NPV? Yeah. It's because you probably got a different long-term interest rate to your net present value discount rate. That's a very Anaraki nugget, but I'm going to leave it with you today. And that is me finished.
Excellent. Thank you, John. I was going to say that sometimes it goes back to what you were saying before about the skill. And I suppose if you've worked in different organizations, then you would have a bit more of an understanding of different parameters, because it's quite difficult to challenge finance when finance say to you, but this is what I'm setting. I know not for you, Duncan, but for and probably not for obviously me or others, but have been in the sector for a while and see the effect it has. But the key element is understanding that risk profile. And if finance say that, you know, this is what we're having, it's sometimes quite difficult to push back on that with not so much evidence, you know, and see what those kind of those challenges are across the appraisals. Sorry, Duncan, you were going to say something.
Yeah, no, I was just going to pick up on what, as always, is an astute presentation from a legend in the sector. But just to talk a little bit about the new shared ownership model, John, if you would, in the context of, I suppose my question is this: is it essential that Homes England provide for a mortgage rescue product or a reverse staircasing, however you wish to describe it, on the new shared ownership model, considering the new initial 10% equity share? Because there's going to be lots and lots and lots of people buying that product who are on the margins of affordability. So surely we should have a safety net provided by Homes England for that product.
I always thought that if you were partaking in shared ownership, you should have plans for mortgage rescue in place. And if you are a dynamic registered provider, then you probably also would add to that tenure conversion as well, because it's about sustaining families in communities where their children are at school. If they face difficulties and challenges, you can still remain their landlord. They can still remain in that community where they've got connections. And I feel that's a responsible approach. When you talk about the new model of shared ownership and people being able to start at as low as 10%, I think a lot of our providers would say, I'm still subject to the affordability process that I have to put on audit file, and I have to demonstrate I've sold the household the maximum share I could sell them under audit, and that's up to 45% of net household income, I believe. So whether people will be buying at 10% once their affordability assessed, I doubt. But you are right, if people are buying at lower levels, well, I think you're right anyway, that anybody providing shared ownership should have a view on mortgage rescue and maybe tenure substitution as well, and reverse staircasing.
Okay, as we've been speaking, the poll has been displayed, and I think people have been filling it out. So we have got some results. Can you see that on screen now? Is that open? So the question was, obviously, for affordable homes, you know, whether you would include shared ownership or not is another question. But rented, affordable rent, social rent, is the net present value discount rate or IRR hurdle rate higher than your long-term interest rate? So exactly what John was saying there. So it seems from the poll that people have answered, 57% say they are higher Am I reading that right? Yeah.
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 Yeah. So whether right, okay. So that there's a question. There's if 57% of the people that did this are saying that, then there's a question to have to go back to the finance people, or at least get insight to it. You know, I would argue you may have a slight higher on shared ownership because the perceived risk is slight on that, because you are exposed to the sector, and if there is a slowdown, then perhaps that. John, comment on that?
Yeah, I mean, I spend a lot of time writing assumptions reports for different organizations, looking at their assumptions against their competitors. And I typically see on shared ownership as much, typically 0.5% margin. Yeah. I would be surprised if it was 1%. It's typically 0.5%.
Yeah, about I'm sure Amanda will touch on this a little bit more because we're touching on finance stuff. So thank you, John. Thank you for our first poll. We will
just before we move off that point, Andrew, just to make one point there is we'll normally have a risk percentage on the actual cost of borrowing, then your long-term interest rate, and then you've got double bubble. So all the CFOs out there literally going, why is he saying this? We wanted to keep that in our back pocket. This is the time to not have it in your back pocket. It's like having a land bank in an economic downturn and going, oh, we don't want to use that. Well, that's exactly what it's for. So it's those sort of conversations you have to have, and you have to be brave enough to have those conversations, but don't do it with just, this is Duncan's thoughts around it. Do it with some evidence, right? That's the point, is you've got to evidence to finance people, no disrespect, Amanda, that you know what you're talking about.
Just very quickly, I know it could be boring, but if you look at your organization financial statements to the 31st of March, if you look at your organization's financial statements, they should include within that their average cost of borrowing. So you can evaluate what the accountants are recording in their financial statements and compare that against what they're telling you is your borrowing rate in development. There's a cat out the bag.
I've got a question. Mark Patchett has said, the main reason I see for having a risk buffer is that the government has interfered again with rent caps, reducing rents below inflation, an appraisal will have assumed 10 years ago. How do we build in rent increases? Interference by government is not a risk buffer.
Do you want me to go, John? You go. I don't mind.
Yeah, I mean, what guidance have we got? We recently had the guidance on rent inflation, and if you look at the regulatory guidance, it's up until March 2025. We haven't got any guidance for the sector beyond that, but the sector are required to keep rolling 30-year business plans. So you've got to make an assumption about long-term inflation, but we're not getting any heads up from the regulator for that long-term position. Most people I'm seeing are using a 2% base inflation, even though we've got alarming inflation right now, and they're adding a small margin to that. But I hear where people are coming from. That's from a finance person. I would have thought. Yeah.
No, he does development, Mark. Mark does development.
And I suppose it's how close you are to your finance team and robustly kind of look at this. And you know, John mentioned there that we do a development assumptions reports. We're here to support you, to give you the evidence, you know, on the background to see what's happening in the sector. And that's one of the kind of hot topics that we always talk about. Right, thank you, John. Moving on, Amanda. Amanda is our finance guru. Recently, you know, not that far, we joined SDS consultancy team and done a lot of training recently and support for teams, a bit more kind of understanding between development and finance. So over to you, Amanda. Same question.
So if you can click through the slides, Andrew, please.
Yep, I'll try and
So-
be a bit quicker with.
So I suppose John was trying to look at alternative solutions. For me, I suppose the theme for my slides today really is about that knowledge and understanding being the key. And that's what we can really do from the finance side. How quickly are we getting that information? Are we interpreting it? We have so much information on the development program, but are we picking up that key message? So we're going to look at that business plan. And as we all know, in housing associations, that business plan is king, and we come back to it time and time again, and we're all bound by that. But understanding what's in our business plan and what changes we might have on that business plan. We're going to look at our costs and how we are evaluating and reporting on those costs and understanding any changes. Looking at how we are managing our program from a financial point of view, and also how we're managing our contractors and looking at the information we have on them. So if you can click onto the next slide, Andrew, please. So I'm sure a lot of your finance teams, and perhaps some of you on the call today, will be hidden in a room on your own looking at business plans, but hopefully not completely on your own right now, but actually talking to the development team, and as a business understanding what changes we are seeing right now, putting those through stress testing, and also seeing what other possible impacts we might see at the moment. Looking at what assumptions our organisations are making on cost inflation. Yes, it's a big unknown as to where we're going to go, but do we know what sort of impact that's going to have? What are we seeing in terms of rental inflation? What assumptions are we putting in there? Also, what do we perceive our changes or anticipated changes to be on our market sales values? What impact might that have on our programme? Looking at what capacity we have, what headroom is there? Are we having to reduce what we can deliver within our business plan, or are we able to maintain it and we've got a buffer there if anything changes? So if our business plan, our programme is including some sort of sales, some shared ownership, have we got an approved strategy if our property is quite sell? And quite often we all kind of refer to rent to home buy as being that sort of exit strategy. But do we know what impact that would have on our programme overall? Do we have a trigger point so where we know that actually this is the point we're going to convert a scheme to rent to home buy? Do we know what policies we're going to have within that, how we're going to manage those properties? Are we anticipating perhaps some lower first tranche sale purchases with the effect on mortgages, mortgage rates going higher, obviously the cost of living going up? Are we expecting that to be lower? What impact would that have on our business plan? How much of a reduction in our market sales value can our programme take, our business plan? Also looking at that about timing, if we start to make some of these changes on our schemes and convert them, perhaps, are we then going to have to change the timings on some of our schemes, perhaps to ride this wave out? We're delaying some schemes, and what impact is that going to have on our deliverability of Homes England funded units? Can we still stick within the timings that we've promised to them? Do you want to launch that poll? We have actually got a poll on this one.
Oh, okay.
Sorry.
Cassie, I think we've got another poll. There we go. Look at that.
Yeah, so I suppose some of you might still be looking at this impact and might not know the answer, but are you seeing some changes in here? Unfortunately, that was meant to be a multiple choice one, I think, but I don't think it's worked in that way. But
so what changes are you needing to make your development program to manage your current pressures? So what changes are required there to manage your program? None, business as usual. Reduction in number of units in the plan. Well, certainly going to be involved in that on our side, is working with a couple of clients, looking at timings. Delaying the timing of some units, yes. Changing tenure mix, that's obviously a bit more trickier one, isn't it? Depending on where they are on the planning process and that conversation. More grant. Well, yeah, that's always a very good one. And then kind of read back, I would come back on viability. Switch to more regeneration schemes. I think regeneration is key across all of our clients at the moment, isn't it? So probably taking a lot away of main development. Changing procurement route and mix. So yeah, we'll have a couple of minutes on that. Anything else to say on that, Amanda, on that poll?
No, and I imagine really people are probably seeing a mix of these things, but it's understanding what impact that's going to have. And, you know, like we said, the headroom that you've got within that business plan, having those conversations with finance. There's no point, you know, you're going to be bound by this business plan. So you need to understand what's in there. And when I get onto sort of the program management, it is all about, okay, things don't happen how we say they're going to happen in the business plan. None of us have got a crystal ball, but understanding how sensitive your plan is, and speaking to finance about, you know, and quickly seeing what these changes, what the impact will have on there. So
yeah, so you can see a kind of nice kind of spread there. So more grant, as we said, change in tenure mix, and delaying a number of units. I mean, that's obviously, you know, everything is up for grabs at the moment, seeing what is the impact that's happening out there. Okay, so I'll end up share the results. I think everyone can see that, and we will move on.
Thank you. Okay. Next slide.
Okay, there we go. Look.
Okay, so then looking at costs, and I've broken this down into two sections. So first of all, I mean, have we got some approved schemes that are not in contract yet? So most likely land-led. So looking to see, have we got sufficient contingency in these schemes to cover any potential increases in cost? And knowing at what position we might need to go back for reapproval if there isn't enough in there. Are our cash flows being managed well, so we can easily see what funds are available within the scheme, i.e. viring our underspend to our contingency, you know, being open. If we know we've got an underspend, keeping track of what's available within our schemes, not hiding buds in other lines, you know, being clear and transparent about what's available. That way, if we do get an unexpected cost landing on our desks, we can easily pick up what's available with that scheme and know when we need to go back. Is your reporting regular, timely, and does it enable you to quickly identify those overspends? No point hiding it until it actually transpires as actual transactions. We need to be picking up and flagging that up through the chains in the business sooner. And is there a clear trigger for when we need to go for reapproval on overspends? You know, we may well be seeing that. Does everybody know what the process is? Quick and clear for people. And then looking at our new scheme appraisals, are we building inflation into those appraisals, knowing that we may not be signing a contract for 12, 18 months, maybe even longer, depending on the complexities of the site and the scheme? Is it transparent? You know, are we putting in there what the costs we might anticipate now and clearly highlighting in Prov on what inflation we've built in as a buffer, if you like, on there? Are we still building in an adequate contingency? Quite often when our schemes are tight and quite challenged, we might be, the first thing that quite often goes is our contingency, but actually in times of unknown, that's when our contingency becomes even more vital. So are we still putting sufficient levels in there and spelling out in our board reports what contingency we've got in there? Stop thinking it's a dirty word. It's not. It's about having that protection, that prudence for the organisation. Are our appraisal assumptions still relevant? How quickly and how often, should I say, are you reviewing those appraisal assumptions? And can we still get appraisals to stack up? And if the answer is no, that's when we're often then going back to board and saying, can we revise these assumptions? So then we get that challenge of how do we demonstrate to our board that these appraisal assumption changes are needed to be able to get schemes to pass, not just for schemes to pass, that they're still good value for money. And it is that it's just reflective of the market and the economy that we're in right now. In Proval, we have those we've got those sensitivity tools within there, so we can be seeing how sensitive our schemes are, and are we using them to support our board reports, and are we looking at the trends within the market. There is a quick poll to put in there just to see how often you're all reviewing your appraisal assumptions.
We might skip that.
Get that, fine. Let's move on.
Let's skip that, move on. Let's get through these valuable kind of content information.
Okay, so we skip on to the next one then, please.
Oh. There we go.
Okay, so program management. Are you managing your approved program and your pipelines together in SQL in a way that enables you to understand the gap? There's no point just having our approved program in the SQL and not also being able to see what our pipeline is that's going to fill that gap, and still understanding what other gap we've got to fill and what impact our opportunities might have versus what we had in our business plan. So always understanding that gap and being able to assess new opportunities quickly as they come in, looking at the unit mix, the costs, the timing of those units, which is obviously key, making sure we don't break any of our covenants, looking at the right tenure mix, and obviously getting those grant commitments and timings with Homes England. Next slide, Andrew. Sorry, a lot of content. So are there opportunities that would be lost if we proceed with a certain scheme? If package deals are available from commercial builders, which are quite few of you are seeing, are you able to quickly understand the impact on these potential deals on the programme overall? Are the costs aligned with the costs that were included in your business plan? Are we seeing costs higher than what we've put in our business plan? And are we quickly able to assess at what point we might be able to have to say we need to deliver less units, or we're starting to eat into that extra headroom that we previously had within our business plan? Next slide, Andrew. And then finally, our contractors exposure. Are we looking at how much of our program we've got with one contractor and what our exposure is if they go into financial difficulties? Are we ensuring that they're not controlling too much of our program? And are you running credit reports and keeping track on those scoring? Even as a finance person, you know, I do put a limited weight to Dun & Bradstreet reports, but being able to see those changes if they're not paying their suppliers, their early warning bells. And so we do have that ability to manage that in SQL. So are we using the tools at hand? So we had to whiz through that, but yeah.
Oh, that's great. All right, lovely, excellent. Thank you very much, Amanda. Are there any questions? Well, there's one question here from Liam, that's what I want to pick up from. We've seen obviously significant increases in build costs over the last 2 years, and discount rates more recently have increased due to interest rate increases. This had a big impact on the financial viability of appraisal. Do the panel see this as being a permanent shift? Duncan's nodding vigorously.
Well, do you want me to answer first? No, yes, I don't. The cost roller coaster will go up and down, and it will continue to be fluctuating, but I don't think it's going to be a particularly long-term trend. I don't think the increase in interest rates for RP borrowing is going to be a particularly long-term trend either. And those astute organisations, not saying that the one that Liam works for isn't astute, will have borrowed money at a significantly reduced rate over a longer period to fund its development programme, and therefore those funds will still be available. So it's up to our finance teams, supported by us, to borrow money at the lowest possible rate they can for the longest possible term.
And long-term rates seem to be coming down, which is a good sign of the economy as well. So that's maybe some light at the end of the tunnel. Okay, great. Thank you for that. Let's go straight to Duncan's presentation. Doesn't need any intro. Thank you, Duncan. Expert in the industry. Let's get into his presentation. Again, same question. How do we maintain maintain output in a downturn?
So John's already proved that my first point is invalid, but thank you for that, John. But I suppose my balanced view on that is we always talk down the market, right? Every commentator, every publisher, every journalist, oh, doom and gloom. Well, we can talk up the market. It's our role and responsibility to say that we're a sector, a bunch of organisations who are going to plough through, and we are going to plough through. We operate best in mild recessionary conditions because of our ability to increase rents, albeit capped at a ceiling, not a cap, John, at a ceiling. Equally going hand in hand with that is we also have access to public subsidy. And what is your grant maximisation strategy is probably my key question of today. I suppose challenge around strategic partnerships, a really good thing that Homes England brought in, but now a fixed grant rate that doesn't substantiate an increased cost environment. So good luck to all the strategic partners out there. How are we maximising the results from our partnerships, right? So John alluded to it earlier, joint ventures are particularly a set of schemes that are close to my heart. Joint ventures are perfect for sharing risk. They will keep the developing partner in work and they will keep the RP in homes. So is it not actually the right time to be talking about coming together to deliver joint ventures, and they can be for whatever purpose and with a different set of organisations, so local authorities and RPs and developers and local authorities, those sort of things. Onwards, please, Andrew, if you may. House price deflation, I suppose that will be geographically led, and you will know your marketplace certainly better than I do, but is it a quantifiable trend in your marketplace? I'm just going to talk a little bit about Wales for a second, you know, that principality over in the west side of the country where I reside. So at the moment, if I'm looking at the Cardiff market where I am, no quantifiable reduction in price, not enough properties on the market, people still able to get mortgages, albeit more expensively than previously, and therefore my ability to buy a house is still reduced at the moment. I'm looking for a little bit of downturn, but you have to test that in your particular geography. Moving on to sustainability standards, which is obviously close to all of us as human beings because our planet is at risk. But from my perspective, it is about, can we invest in something now that we can improve more easily and efficiently later? Because you spend less now, can put those resources into Amanda's unicorn business plan, and at a later stage you can utilize those resources to come back to the properties that you've built today to bring them up to standards. But you have to design that in now, so you have to make sure that they are improvable in the future, and I think that's probably a key point. Moving on to governance, which is an albatross that weighs around all of our respective necks. But is it good enough and quick enough to cope with quick changes? Have we set our organisation up and our governance structure within that organisation to cope with an environment that John Stevens' opportunities can be easily evaluated and approved? And I think that really is a very, very key question for lots of RPs, because governance is cumbersome. And you have to get yourself to a position of creating a governance structure which isn't. And I'm sure that people at SDS or myself can help you with those matters. We've talked a lot about viability and benchmarks, but it couldn't be any more core to doing business in a downturn. And I'll come on to that in a second. Hand in hand with Amanda's business plan discussion, does your development strategy need to mirror the business plan resources? Are there changes that need to be made? Is there stress testing that needs to be brought in to make sure that all of the things you're doing are joined up? And my answer to that question is definitely yes. You have to work with partners. I'm not saying you have to do joint ventures, but you have to work with partners. Is your relationship management with those partners the best it possibly can be? I'm not talking about having friends. I'm talking about having respectful work relationships that get you the outputs and the schemes that you need to deliver your program. Who are those partners, and what do they need? You need to ask them those questions, because their aims, objectives and priorities are a hell of a lot different to what yours are. So you need to align those two things together and agree a set of mutual objectives. Our buying power as a sector can help them. Yeah, so we have long-term supplier frameworks, long-term contractor frameworks. Is that something we can help them with to buy better and more efficiently to deliver cost savings on projects? Onwards, Andrew, if you may, please. To tender or not to tender, I mean, I'm perfectly happy to say this in a public environment. I hate procurement with every single sinew of my being. So what we have to do is make sure that the procurement tail is not wagging the organisational dog. And by that, I mean, get to a perspective where you are in a good relationship with those procurement people in the organisation who can help you get your project through a procurement process and onto site as quickly and efficiently, and obviously with cost in mind, as you possibly can. What existing regeneration opportunities do you have in your organisation? Can you do them another way to create more homes? Right, that's a fundamental question. Do we once again need to have the spectre of internal subsidy that's lifted as money from the business plan to assist? Possibly. I would err on the side of caution for that, because all you're doing is stripping resources out of that business plan for future development. Can we take advantage of the market conditions to buy land? And I think that's probably, again, point number 2 on the critical scale, is recessionary conditions drive RPs to be able to compete in a marketplace where they traditionally cannot. So go and compete, go and buy land, go and secure things now and for the future. Thorny one at the bottom, everybody says there's a lot of risk in management contracting, or buying a contractor, or creating a contractor. Well, you might be the only show in town, because the rest of them might have packed up and gone home. So you might have to do it. So it is worth having that conversation internally about whether that's an option for you. Go on, mate. Right. What's our relationship like with our finance colleagues? Well, it's an interesting point, because you're both working for the same organisation, you both want the same thing, but actually they're very risk averse traditionally. Some aren't, very risk averse traditionally, and development people normally are very risk hungry and commercial, maybe a little bit like me. And you just have to have that respectful conversation to say, look, if we're not doing development, you're also at risk, because you're going to have to pack up and go home as well, and somebody else is going to do the rest of the organisation. So it is in our mutual interest to work together. Amanda's points are very, very strong around transparency, and I really would reinforce that. It's a good idea to be innovative, but you have to be transparent with that innovation at the same time, and really transparent with your boards and committees. Doing something innovative is good, but do it transparently and make sure other people have approved it. Really big on benchmarking of KPIs and assumptions. For me, for Duncan's view, that's a development-led activity which is supported by finance, not a finance-led activity supported by development. Take control of that. Have to provide evidence, get benchmark by third parties like the venerable Mr. Stevens or others, and present that back to your organisation with a recommendation to change. Is your MPV period long enough? John's talking about 60 years. 60 years, I think, is probably around the benchmark in the sector, John. I don't know, you'll tell me after when we have a chat. The IRR, or first year of surplus benchmark, I kind of find it a bit old-fashioned now, but it's still there in some organisations. But the question to ask your finance colleagues is, what is your programme against your stock? So, you know, if you're only doing 100 homes against 10,000 units of extant stock, what's the point in having that benchmark? Because you're not adding any significant downturn to the income in that period, and your stock's got that covered. Long-term cost of funds, John Stevens took the words right out of my mouth, so I won't go into that again. Onwards, Andrew, if I may. Long-term repairs and maintenance allowances. Again, John's gone through that. I think with sales, what I'd say about shared ownership is simply keep calm and carry on. Although the new shared ownership model will have probably a reduced level of initial equity tranche overall, because the 10% will affect that. So if it started at 40, maybe you want to think about 30. But in terms of sales values, don't gamble on sales values. That's Duncan development mantra #1. Don't gamble on sales values. It's not worth it for your land value. It's not worth it for everything. Just don't gamble on sales values. And make sure that your finance colleagues are happy with your stress testing. Get them to do more stress testing. Have multivariate stress testing if your auditors tell you to do so. But do it, and then have an exit strategy associated with it. And then again, I've talked about margin benchmark on open market sale. We're the only organisations in the world who will be able to reduce our margins on open market sale without it having a problem for the rest of the organisation, because it's not our core business. So that's again a sensible conversation. Go on, Andrew. Lots on there that I probably won't go through in detail, but SMEs deserve to be supported. Payments deserve to be made more quickly, if possible, if it doesn't cause too much of a problem. Insurances and warranties are really hard to get hold of. So is there another way? And can we provide that insurance as a block policy for our contractors to buy into? That's a really interesting thing that warrants a bit more of a discussion. And is our contract fair? B&B is wonderful for us, protects us from all risk, but is it fair to the contracting industry? My answer to that question is probably no in a cost increase environment. Anyway, move on, Andrew. Section 106 might not be here for long. Take hold of it. Make hay while the sun shines. Get it all in your programme, right, as much as you possibly can.
Yeah.
Subsidy. There are other funders out there than Homes England. Yeah. Combined authorities, local authorities, get hold of their money to keep your programme going. Keep going, Andrew. So, summary, finish, don't panic, Captain Mannering, it's all fine. But we've got to talk that up ourselves. So we've got to make sure that the no panic message is out there. Now is the time to use your land bank. If you can't use your land bank now, you'll never use it. So just test viability across different tenure options. If you bought it for open market sale and it doesn't work, get some grant into it. Partnerships, partnerships, partnerships. You've got to work with other people, do it properly, have some respectful business relationships that work for both parties. Do regen, but appreciate it takes longer. Procure clever, and ensure those internal conversations are positive all the time. We can deliver, we can deliver, we can deliver. Thank you very much.
Fantastic, Duncan. And there was one more slide. Was that? Did you cover that?
And horizon scan, the one at the bottom. You've got to look forward, and you've got to have all of the data that you possibly can.
Absolutely, yeah, I can do it. Yeah, definitely get as much data as information as you can, communication data, and go out and then buy some deals and get some option agreements going. You know, you're in the right position to do that now. Right, we've got about a minute left for anyone who wants to fire a quick question to the panel. Whilst that is happening, I want to say thank you to everyone, to the speakers. Thank you for your time and putting those slides together. Lots of data in there, good data as well. And someone said, can we have the slides sent to us? That's exactly what we're going to do, Claire. So we will send you these slides in a few days. They'll be available for you so you can see them, digest them. And obviously we're here to answer any questions you want. Please pose any future topics that are burning that you want us to kind of review and talk about. As I said, we're trying to do these kind of once a month. And I'm pleased to say that we next month will be a slight change. It'll be on a Thursday due to Jonathan Walters has agreed to come back and do a Q&A and talk the things he can talk about. He's obviously the Deputy Chief Executive of the Regulator of Social Housing. So he'll be here on the 23rd of February at 10 o'clock. And again, you know, for an hour, and he'll do a presentation. We can ask any kind of questions from him from there. Right, are there any last questions to fire at somebody. Apart from, all right, okay, Claire says, fantastic, much appreciated. This will go towards her master's course. So that is all very well. We're happy to oblige.
As ever, Andrew, I'm writing Claire's assignments.
Oh yeah, we're writing Claire's assignments. That's what we're doing. We're happy to share the love at SDS. This is what we do. So please have a good day. Thank you for attending. Thank you, speakers. I will see you soon. And have a good rest of the day, everybody else. Thank you.